4, 3, 2, 1, and go.
Hey guys, look, it's awesome. I have my friend Michael Litt here, the global strategic advisor here. And you know, one of the things that Michael and I have talked about over the years has been the Fed and the way that it has impacted the economy of the United States and almost pretty much led the world around the world. Michael, good to see you again, man. How are you?
Stephen, good afternoon. Good to see you both.
Yeah, especially after sports this weekend. But hey, you know, look, Michael, there's a lot going on besides that. There's an election going on, and I think a lot of people are very nervous in the markets, and you're starting to see that temper and starting to filter into the markets, especially. Let's start out with the big one, the big bond market. Talk to me a little bit about what you're seeing in the bond market right now.
Yeah, you've seen some scoring for the proposed policies, or at least the policies the two candidates are stumping on. Yeah, I think it would be difficult for any candidate in this day and age to go out with a program that would actually cut the deficit, because the other candidate could really cut their Achilles tendons for the kind of things you'd have to do, right? To deal with the deficit and the growth of the deficit, which is something as a country we really need to wrap our arms around. The partisan politics in this country really don't allow for it. And it's interesting, John Adams said that we would come a day in democracy where we will spend and spend and not have the will to not spend to get reelected. And he actually, that's not the exact quote, but in essence, that's what he said. And we seem to have arrived at that moment in time that Mr. Adams had predicted. Just about 250 years later, here we are. The bond market is clearly reacting. JP Morgan and Haver Analytics, I think Oxford Economics, they've all looked at the policy. They've done some scoring. Obviously, Trump's tax cutting has a bigger impact, but the net impact was $3.5 trillion from Harris's policy, $7.5 trillion increased deficit from Trump's policies. Who knows if, you know, there's a lot of talk. Who knows if all of that is going to come to light.
You know, it's interesting. The FDIC put 60 banks on the naughty list with a little more than $500 billion in unrealized losses. The Fed has to be looking at that closely. I mean, there's some serious problems here, some cracks, shall we say.
Right. Well, I guess to finish the prior thought, the problem is that nobody is campaigning on a deficit reduction,
right? Of course,
policy platform. So the bond market might be getting a little fearful of the reality of either of those, the magnitude of the increase in the deficit between now and 2035, and those are the time frames for those numbers I threw out earlier. You know, when you talk about the commercial real estate, people use this term, there's a wall of debt coming due.
Yep.
I was talking to a really, really seasoned institutional real estate investor, and he said, there's always a wall of debt coming due. They finance for 5 or 7 years, and a lot of things got refinanced when rates were low in 2018 and 2020, and they're coming due in 2025. So the wall of debt is not some special item. It always happens. Now, what will actually happen is that the banks will refinance that wall of debt. They will push it. They will kick the can down the road. There will be some where things are bad, where cash flows at a property aren't servicing, just minimally servicing the debt, right? Most of the commercial buildings won't qualify under the normal metrics, but so long as the debt exists on the bank's balance sheet, they'll push the debt out again, right? and it'll be at a higher rate, or they're going to have to take some sort of 20, 30% haircut to it to make the deal work. But that can will get kicked down the road. In terms of duration assets that are underwater, a lot of those are still in hold to maturity accounts. And that's not, unless the banking system is going into liquidation because we have a credit crisis. So let's separate credit from the duration losses, right? The banks are not having in fact, bank losses, if you look at credit losses, they're really at very, very low levels. They're at historically low levels. So the banks are not having credit problems. The banks' balance sheets are sustainable for that reason. Their cost of funding is coming down. The curve is not inverted anymore.
Right.
Right? In fact, the curve now, you're getting a bear steepener. Nobody expected a bear steepener over the last 6 weeks, but
Right.
you got a mild bear steepener with the 10-year now at 417 and short. So you're getting a more positive rate environment from a bank's perspective. You have a constructive credit environment. So I am of the mind that, like the commercial real estate loans that will mostly get refinanced and pushed further out, there's equity. There are going to be equity losses realized. There may be write-downs on some commercial real estate. A lot of it's going to get rolled and pushed out. The wall of debt is not what people make it out to be. And there's no stress in the banking system that would make me believe that the mark-to-market losses on duration, which was the problem our friends at Silicon Valley Bank had, as we recall, but their balance sheet was not sustainable because of the deposit withdrawals. Hard to find banks right now in this environment that don't have sustainable balance sheets to be able to continue to, and you work that off. That hold to maturity works its way off, right? And as the duration of those holdings shortens, the losses also shorten because you start approaching money good par values, and the interest rate differential between, say, you invested in a mortgage or something at 2.5, and now the yield is 4. As you get down to 1, 2, 3 years duration, that will go away. It will mitigate. Now, are they underperforming on the current yield they have on those assets? Yes. But is that going to take the banks down, or is there a sort of a day of reckoning in front of us? I strongly suggest to the crowd, no.
Then what do you say to people like myself who are looking at Warren Buffett, who's selling Bank of America stock, who is raising cash at the biggest clip ever, the biggest cash pile in history for Berkshire Hathaway, really can't find Alpha? Sirius XM is the last thing you bought. What do you say to people that go, okay, well, why is Warren dumping the banks?
Well, I think there has been a pretty big recovery in bank stocks. They're not, but they've done well. Stocks in general, as we discussed in the direction of travel, are, especially the large cap, mega cap stocks, are at elevated prices. And the idea of I am not at all, would not be at all, and I even talk about it in the paper, we could be in, sentiment is bullish enough that we could be in for a correction. Rates backing up. A lot of things tell me that, the market might be whistling through, not through the graveyard so much, but whistling past the graveyard, right? And a correction would not surprise me. Does that mean
define that correction, 10, 20, 30%?
Well, as I said, I think that's a 10% correction.
Okay.
If either of the candidates nullify Fed independence and the White House has any say in interest rate policy, 30 to 35% bear market.
Oof. All right.
No, a loss of independence from the Fed is exceeding is the worst thing that could possibly come out of this election.
Yeah, and you hear Trump talking about that he wants to have more say about the Fed and who's there, and pretty much dictate whether or not they raise or lower rates. But to me, it looks like that. When you look at it from both perspectives of both candidates, they both want to change up the Fed themselves. They're not really happy with who's there, but for different reasons.
Yeah, well, listen, Trump's comments are irresponsible and dangerous. And I think Stan Druckenmiller was on CNBC the other day saying he literally parroted what I had said when we spoke last time. So there's no question that's heinous. Getting Elizabeth Warren involved would also be, which is on the Harris side. Elizabeth Warren was a Monday morning quarterback after the great financial crisis, but she was in league with Dodd-Frank, who basically greased the skids with Fannie Mae and Freddie Mac to compete with the banks and created the environment. And when I lecture at business schools on this, I talk about the environment that was created by Chris Dodd and Barney Frank.
Right.
She was in league with them, and yet then she turns around and becomes a Monday morning quarterback. I don't really think she understands finance very well. She would be quite dangerous. I think she probably couldn't do quite as much damage as taking away Fed independence and having the White House making interest rate calls or selling those interest rate calls to somebody to give them a little inside information. We cannot have that. And that's what Stan Druckenmiller said. We cannot have that.
And I always believed that the bond market traders are the smartest traders because they're dealing with the most money. They're way ahead of the game sometimes. Do you see the Fed another 50 basis points to the downside, or what are we seeing here for the Fed looking at the bond market?
I think the Fed has got considerations beyond the headline numbers that we look at, and everybody sort of runs from one side of the ship to the other every time a number gets reported. There are small businesses who borrow at floating rates, who have a cost of funds that's too high for a 2.2 to 2.4% inflation. And inflation's getting really sort of baked in down here in the mid to low 2%. And it just comes out every time. It's a little lower, and it's stable. And, the only thing, it's funny, the only thing holding retail sales back were the drop in gasoline prices. And gasoline, as you know, is inelastic. We don't buy more gas or less gas when the price moves. We have to go to work. We have to drive the kid to school. We have to get in our truck and drive, the shipment of bathtubs from, manufacturing site at Kohler, Wisconsin to, LA. So you've got the fuel consumption is about level, but when price drops, it drops retail sales. So when you read through, retail sales are strong, employment's strong, wage gains are 2.5% real, which is fantastic for this country. That's ultimately the most bullish thing. But
and yet I saw where FedEx was saying for the holiday season that they were not going to increase the number of people that they hire for the holiday season. They're going to keep it the same number, possibly less hires. We saw UPS numbers, FedEx numbers coming out. They were a little softer and neither CEO is talking very strong about the holiday season. So
if the holiday season isn't the bump in terms of deliveries that it used to be.
Right.
Because you have all these deliveries to homes, you have a lot of capacity for deliveries. I saw a speech on this by a guy from DHL. We spend more money on the holidays in stores. We go to stores, we buy stuff at stores. So FedEx and UPS, they can deliver, LTLs get delivered to stores, we go pick it up. Oddly enough, the bump we used to see in holiday delivery traffic is not as pronounced now because the baseline, because of internet purchases, is so much higher. Does that make sense?
Yeah, totally.
So I don't know if that's an indictment on expected holiday sales or not. I'm not going to speak to that directly, but I do know that holiday delivery volume traffic is closer to what our baseline is relative to what it was, say, 10 years ago.
Right. I'm going to switch up a little bit. We're going to go across the pond a little bit. The news about Germany's manufacturing is getting worse and worse over there. Obviously, we talked about that, the granolas, right? The big stocks over in Europe. Look, Germany is the manufacturing hub pretty much of Europe, and the numbers there are getting worse and worse. Is that going to equate to the United States?
I was in Europe, and I was talking to people who had, I had speaking with some Germans who were involved in subcomponent supplies to the auto industry, and I think you call it the small companies. They're called the Mittelstand, or the middle. Is that the word, Mittelstand? I mean, a number I was given was down 17%, and a consultant from Dublin, Ireland, told me that it's a real thing, and they're really getting pressed. Part of the issue, he said, is their work rules and their inability to flex into new modes of production.
Okay.
And part of it is, their cost structure, which, like our cost structure, Germany more fully loads the cost structure with healthcare and benefits, right? And so, and Europe is in a much slower growth mode than we are. Do I sort of take the Mittelstand, the pressures on that manufacturing base, and then just apply it to the United States? I don't know. I see in the United States the trades and the union. I talked to a guy in Chicago who on the, is like leader for a lot of the IBEW, plumbers, pipe fitters, and he said they are like fully employed. Their backlogs are huge, I don't know if it's the onshoring, the fact that our economy is stronger. I can't translate one into the other to your original question. Does Germany's Mittelstand pressure translate to the United States? Not seeing it. It's hard for me to completely derive the origins of what is happening in Germany, which is happening in Germany. And it's certainly almost impossible for me to translate it into the US, because we're seeing something very different.
Well, I mean, for me, seeing things differently, it would be when you see Boeing on strike, when you see the longshoremen on strike. Maybe it's not manufacturing, but maybe it's our labor that's having the issues over here. But comparing Europe's strong manufacturing, because I think that's what Trump and Kamala are both saying, that they both want strong manufacturing and a weaker dollar here in the United States. Trump saying it wants a stronger dollar. But to me, there's labor issues on our side that we're not seeing on their side of the pond.
Right. Well, as we know, presidential candidates talking about the dollar would be like you talking about getting in and turning around the New York Giants football team. You may watch the game, but you have no say in the matter, right?
That's right. Yeah.
The truth is, the demand and supply of dollars are not something the president of the United States. Now, they can have some policies that impact it over short periods of time at the margin, but it's just not. It's a structural issue that gets to almost everything. Demand for dollars. I mean, think about the global equation. It's got, it's a 75 factor equation with, changing coefficients on it. And so they don't have anything to do with that. As we've seen, University of Chicago put out a thing about tariffs to remind everybody that it ends up backfiring. We talked the other day, that Europe put some tariffs on, I think it was Chinese electric cars, and the next thing you know, you couldn't import European brandy and cognac into China. So it's like, tit for tat. You end up, it's a zero-sum game.
It's a zero-sum game, absolutely.
It's a zero-sum game. And anybody who says like I heard Ray Dalio talking about all the revenues that the tariffs are going to create. And I said, whoa, time out, subtract the reduction to GDP and the loss of jobs. It doesn't, it's never worked and it won't work, but it sounds good. You know what I mean? It sounds good if you're Kamala Harris and you're up on a podium somewhere, or you're Donald Trump and you're in, Jones, whatever the place they had the flood, Pennsylvania, Johnstown, Pennsylvania, right? I was going to say Jonestown. I'm like, wait, no, that was a different event. Yeah. No, I don't know. I think they both talk about, U.S. jobs. And right now, thank God, we have a very good jobs picture in this country. And the savings and onshoring, again, I go back to our medium and long term, it's really going to be rates coming down and household formation and the sort of balance sheet expansion, because people in this country have the wealth and have the income wherewithal to expand their balance sheets. That home purchasing cycle and then the home building cycle that it will draw in will create the durable goods purchases that will drive us.
But yet
that's in the medium and long term. In the short term, we could get a correction.
That's what I was getting ready to ask you. Right now, we're seeing the 10-year at 4.18%. So
yeah, that's a new high rate, right?
It's a new high rate.
We haven't seen that rate since I think the 4th of July.
Right. And that's what we're saying. I mean, I'm seeing on social media that this is going to be a blip and then we're going to come right back down with rates. But that's what I was asking earlier about the Fed. They're seeing this going, wow, we just lowered it 50 basis points and it really didn't have much of effect. So they're going to come back in and go, okay, well, labor's good. Okay, manufacturing's good, as you say. And then you're saying that holiday sales are going to be okay. But then why would they lower 25 or 50 basis points? Why is the Fed becoming in the crosshairs?
Well, again, the Fed doesn't control 10-year rates. The Fed is managing, and I think that the bond market had gotten way out ahead of itself.
Yeah, there you go.
And way out ahead of itself. When the 10-year got to 368, I said, 368, that's my terminal rate for the 10-year, in March of 26. How do we get to 368 in, September of 24? So to me, it made absolutely no sense.
The Fed hammer, right? So we've been talking about the Fed hammer is what caused it, right?
Maybe it was like a short covering rally, massive removal of interest rate hedges, and
right.
But you had the normal supply of treasuries coming to market, and it chewed through that and then some. But I said when we spoke, I said I envision a world where we have 2.5% short rates and 3.75% long rates, 10-year, right?
Yep.
Call it the 30-year at 375 and the 10-year at 360, and mortgage spreads back down to where you're seeing a 4.75% 30-year. That's what I envision for the end of this rate cutting cycle, to where 2.25% short rates or 2.5% short rates are 25 or 50 basis point real.
And that should make housing prices go back up. People should be happy, feeling good about the economy. Mortgage
refinancing would come. And I think once you have a 4 3/4 or even a 5.5% mortgage rate, you're going to get, it's all relative. It's relative to what you've.
I was going to say that people who did 3.5 back 4 years ago might not refi.
No, they won't. But young people who've been looking to buy a home, who are looking at 7 and 6,
right. Or no longer
5.5 or 4 3/4, that's going to make home prices affordable. And remember, we are not going back to ZIRP. We're not going back to a zero interest rate policy. I mean, that's not where the Fed wants to go, right? They want to have positive real rates along the yield curve because that engenders the rational allocation of capital in a capitalist system. And that was not in place, after GFC.
Right. All right, so let's get some answers out of you. The question for me is 25 or 50 at the Fed next meeting here. Which one are we going?
I would say they'd stay on a 25 basis point rate cut,
Okay.
and they'll do that 2 out of the next 3 meetings.
And depending on the election, does Powell keep his job?
Well, my view, he should keep his job. I don't know, the guy had to raise interest rates to get rid of inflation, and he did his job.
Okay.
And, you'd think they'd take the target off his back, but maybe, people who like to sit on front porches and bitch and complain, red and blue front porches, you know what I mean?
Is he the fall guy?
Bitch about the guy who raised interest rates causing all your worldly problems. The truth of the matter is he should keep his job. Will he keep his job? I don't know the answer to that question. I worry a little bit about that. I think the bond market is worrying a little bit about that. That's what's in this move back up. It's also the move back up has to do with the bond market having gotten out over its skis. Right. So it might be getting out over its skis the other way now. We don't see it in the inflation numbers. The interesting thing that I have heard from 4 people in 4 different industries is there have been some what they call purchasing deferments or purchasing hesitation until the election is over.
Yeah.
People are like, I don't want to do that until the election is over.
Right. And, the nervousness, and I'll leave it at this because it seems to be that people are buying gold and silver and commodities at a big clip here. I mean, we're seeing silver now at $34 an ounce, gold at 27. They're buying gold at Costco now. They're buying silver and platinum at Costco. I mean, I have never seen that in my life where, normally you go to reputable places that sell metals, and they're doing that now and selling out of it. It seems that the nervousness is all the way down to Main Street.
There's a lot of anxiety around this election. There's a lot of anxiety. Retail investors buying silver and gold and platinum, right?
Yeah.
Costco or anywhere, is not a good sign for the asset. That having been said, we talked last time, China is legitimately trying to get its gold holdings up concomitant with its central bank operations in the size. I would, whatever you read Chinese GDP is, some people say to haircut at 35%, some people say haircut at 20%. I'd say, a 25% haircut to Chinese GDP would be a reasonable guesstimate of what it actually is. They use these things where the satellite flyovers look at the lights and they can actually count lumens, and they estimate actual GDP growth over time from that. But there's other metrics. Even at a 25% reduction in GDP, they need to substantially increase their gold holdings, which they're going to do over time.
Right.
And that demand is there for gold. So
and it's not just China. I mean, the demand for for gold is also very high too.
Yeah. But I mean, China's they don't want to hold dollars. Russia doesn't want to hold dollars because of the 300 billion that's still trapped. You know what I mean? That's sanctioned, part of the sanctions. And so Russia's has one reaction. China's is partially that, and it's partially the fact that they are trying to get their central bank gold holdings up. retail buying at that kind of thing always concerns me a little bit, because those usually are markers of tops, but there seems to be enough momentum in precious metals and there is some legitimate. I try to drill through to say, okay, who is buying this barbaric metal? Because historically, it performs what it does. It performs like T-bills, right?
And the biggest buyer of T-bills has been Warren Buffett lately. So look at that.
Well, and then Buffett, let's go back to Buffett, because I didn't touch on that. Charlie Munger is not among us anymore.
That's right.
And, I think people really underestimate how critical Charlie Munger was to Warren Buffett feeling confident in putting money to work in investment decisions. And I think people, assuming that Warren Buffett can operate at the same velocity without Charlie Munger, I think would be a mistake.
Okay. We'll leave it at that then. Okay, I like that answer. All right. Well, as always, Michael Litt, my friend for many years now, and the guy who I will never, ever, ever doubt when it comes to the markets. Listen, you're the guy to listen to, man.
Don't lean too heavily on that limb, Stephen. It has a tendency to break from time to time.
You're still a Cubs fan. We'll leave it at that, man. All right, brother. I'll talk to you later, and until next week, Michael.
Good luck investing, everyone.